Hello, I'm Anthony Saglimbene, Chief Market Strategist at Ameriprise Financial. Welcome to this episode of Ameriprise Talks, where our panel of experts share their outlooks on the market and economy to help you make sense of what could be in store for the second quarter of 2026 and beyond. I would like to introduce Russell Price, Chief Economist at Ameriprise, and Brian Erickson, Fixed Income Strategist at Ameriprise. Thank you both for joining me. Before I dive into questions, I'd like to briefly set the stage for viewers. While markets began the year on strong footing, stocks have faced sustained pressure over the past few months. Much of that has been driven by investor concerns around artificial intelligence, as well as the ongoing conflict in the Middle East. And specifically, the war in Iran has added a new layer of uncertainty to the broader macroeconomic backdrop. With all of this in mind, it's worth stepping back and reassessing how these developments are impacting the economic outlook. Russ, I'll start with you. Given everything we've seen unfold so far in 2026, how has your outlook for the economy evolved? And as oil prices rise, how concerned should investors be about a recession or inflationary risks?
Well, Anthony, the situation in Iran has led us to lower our outlook for economic growth this year. We're now forecasting the U.S. economy to expand at a real rate of about 2.2% versus the 2.6% we estimated at the start of the year. The key change is less consumer spending power in light of the jump in gasoline prices. In late February, national average gasoline prices were running at about $2.90 a gallon. More recently, that same gallon of gas is costing over $4. And prices could go higher still the longer the Strait of Hormuz remains closed to most traffic. That area of the world is also a major producer of fertilizers and plastics, so we could see higher prices for food and packaged goods as well over the time. Though the situation remains highly uncertain, we currently see inflation, as measured by the Consumer Price Index, is likely to peak at a rate of about 3.5% in the next few months. In February, the rate was 2.4%. Overall, crude prices would have to get to over $150 a barrel, and that level would likely need to be sustained for a period of at least 6 months for a recession to be a real risk. And economic activity should reaccelerate when energy commodity prices eventually come back down. Despite the jump in gas prices, the economy's underlying fundamentals are still in good shape. Business investment spending related to artificial intelligence initiatives is still strong. Consumer debt burdens are low by historical standards, and the job market is improving. According to the Labor Department, the U.S. economy added a strong 178,000 net new jobs in March, and the unemployment rate slipped to 4.3%. With that said, Anthony, I'd like to get your perspective about how markets are responding to the events of late. Obviously, stocks are trending lower. What are the chances we see more downside pressure? And what are the big market indicators that you're tracking?
Well, Russ, as you mentioned, stocks have struggled to sustain any upward momentum lately amid selling pressure across tech and the unfolding conflict in the Middle East. If you recall, the S&P 500 reached an all-time high in late January, but lost momentum as the first quarter progressed, and investors began reassessing several key themes that had powered stock gains last year. In our view, the biggest drag on the overall U.S. stock market at the moment is still coming from mega-cap technology and software stocks. Despite strong earnings and favorable outlooks for this year, from tech and tech-related companies, the AI theme is showing increasing cracks as investors question whether the enormous spending on models, data centers, infrastructure, and hardware will yield returns sufficient to warrant the investment. In addition, growing AI disruption concerns are adding pressure both inside and outside of tech, contributing to increased investor anxiety across public and private markets. And obviously, the ongoing Iran conflict and spike in commodity prices, such as oil, are calling into question earnings estimates for this year across a range of non-tech cyclical sectors, including consumer-facing industries where higher input costs could erode profit margins or cause companies to pass on these costs to consumers already resistant to higher prices, which by extension could ultimately erode demand the longer commodity prices remain elevated. So to answer your question directly, Russ, yes, stocks could see further downside from here. In our view, headwinds are growing and becoming more immediate compared to the start of the year. Middle East violence remains unpredictable and raises risks for global trade and corporate profits outside of tech that were not present at the start of the year. As a result, higher commodity prices and firmer inflation trends could prompt the Federal Reserve to maintain a higher for longer rate stance, keeping financial conditions tight and exerting pressure on growth-sensitive assets. And if AI momentum continues to soften, it may be difficult for markets to move higher given the size and influence of mega-cap tech companies across major U.S. stock averages. At the same time, we believe stocks have already discounted at least some of these risks. In our view, earnings trends remain supportive, and first quarter profit reports in April and May could help stabilize equities absent further dislocations from violence in the Middle East. In addition, corporate profit margins are strong, earnings revisions actually improved in Q1, and stock valuations, especially in technology and mega-cap stocks, have come down materially from their late 2025 highs. And as you indicated, Russ, the labor market is improving, productivity growth is firm, and weaker stock sentiment over recent months has actually left parts of the market oversold, conditions that historically have often supported a rebound once uncertainty begins to ease. As Q2 begins, we believe investors should expect continued market volatility, ensure they are comfortable with what they own and how their portfolio is allocated, and reach out to their Ameriprise financial advisor with questions and concerns. I want to bring you in, Brian, for this perspective on fixed income. Let's talk about what's happening in the Middle East and the impact decisions made by the Federal Reserve and the 10-year U.S. Treasury yield. And to that end, how might bonds bring some stability to portfolios during this period of uncertainty?
Thanks, Anthony. Coming into the year, we anticipated the Fed might cut its key policy rate by 0.5 percentage point. The constrained flow of crude from the Middle East has clouded our view that inflation could move towards the Fed's 2% target in the second half of the year. As a result, we see the Fed on hold until there's greater visibility around inflation, both short and long term. This could push Fed rate cuts into next year. In conjunction with the March payroll report, inflation could raise prospects that the Fed may need to raise rates. But we see the odds of that as relatively low unless energy prices remain high for a prolonged period of time. Inflation is one catalyst that can lead to negative total returns in both stocks and bonds in the very short term, frustrating diversified investors. But given the Fed's goal of managing price stability, inflation tends to rise but then fall over longer periods, typically restoring the diversification benefit of fixed income in blended portfolios. Bond returns were positive at the end of February before global crude and energy prices spurred a rise in inflation expectations, lifting bond yields and sending prices lower across the curve. The U.S. aggregate ended the quarter with a modestly negative total return as inflation weighed on both fixed income and equities. We continue to see fixed income yields as a solid contributor to income and performance in long-term portfolios. Yield levels, especially in high-quality fixed income, can offer moderate gains from just holding fixed income as coupons support positive performance. Investors looking for greater inflation protection might consider inflation-protected strategies, including Treasury inflation-protected securities, or TIPS.
A big thank you to Russ and Brian for their thoughtful commentary, and to you, our clients and viewers, for joining us. At Ameriprise, we're committed to giving you the information you need to help make more confident financial decisions in any market environment. For additional timely perspectives from the Ameriprise Investment Research Group, or to explore how these insights apply to your portfolio, connect with your Ameriprise financial advisor. Thank you.